So today we're diving into the 2026 stablecoin landscape report and some of the latest treasury analysis. We're trying to answer a pretty big
It's
question.
a trillion-dollar question, really.
Exactly. Are stablecoins the future of payments, or are they becoming a systemic risk to the US bond market itself?
We've got the data in front of us. Let's get into it.
Okay, so the headline number from 2025. I mean, it's honestly hard to ignore. Stablecoins processed $33 trillion in transactions.
It is a staggering figure. And to frame that for you, that means stablecoins have now officially surpassed Visa and MasterCard combined.
Wow.
But the real story isn't just the volume, it's the velocity. We are literally watching the global financial plumbing get ripped out and replaced.
Right. Visa and MasterCard take, what, 24, 48 hours to actually settle?
At least. Stablecoins are moving billions in seconds, 24/7, all on chain.
And it's an incredibly top-heavy market, unlike those credit card networks. We're looking at a $310 billion asset class.
Yep.
But 99% of that is denominated in US dollars, and it's really just a duopoly,
It is. Tether and Circle. They control about 85% of the entire market between them.
which creates this fascinating and kind of scary power dynamic.
Well, yeah. I mean, think about Tether. It isn't just a crypto company anymore. Not by a long shot.
With what they hold in T-bills, you mean?
Exactly. They have approximately $141 billion in U.S. Treasury bills. They hold more U.S. government debt than Germany does.
So they've effectively become a pillar of the U.S. Treasury market.
A systemic one. And that context changes everything. It completely explains why the Genius Act, which President Trump signed in July 2025, was such a pivotal moment.
Because the government wasn't just regulating some crypto bros anymore.
They were regulating one of their biggest lenders. The Genius Act ended that Wild West era.
So it mandated the one-to-one backing.
Right. It said payment stablecoins have to be backed one-to-one with high-quality liquid assets, cash, treasuries. It basically shut the door on algorithmic experiments for good.
And we all know why that was necessary. I mean, the collapse of Terra USD in 2022 just...
Evaporated $40 billion. It was the ultimate proof that math is not money, that code isn't collateral.
And then the SVB collapse in 2023 showed that even asset-backed coins have risk. But okay, so the Genius Act fixed the backing issue.
It did.
But when you look at that Athena incident from October 2025, it clearly didn't solve the infrastructure risk.
That is the critical distinction. Athena's USD, it suffered a pricing error. It was just a glitch in a data feed.
But it triggered a $19 billion liquidation scare.
Yes, the collateral was fine, the backing was there, but the plumbing broke. It showed us that even with a federal rulebook, these automated systems create flash crash risks that, traditional finance just doesn't really have in the same way.
And yet people are clearly willing to accept those risks for the utility. Cross-border payments are a huge one.
Oh, absolutely. It costs pennies to send money versus, a $50 wire transfer? The adoption is massive.
But that brings us to what the data calls the legitimacy paradox. While legitimate use is soaring, so is illicit use. Stablecoins accounted for 84% of illicit transaction volume since 2022.
It's the double-edged sword of efficiency. The same speed that helps a grandmother send remittances also helps a criminal launder money.
They've basically replaced Bitcoin as the currency for that.
Of course, criminals hate volatility too.
But the U.S. Treasury seems willing to accept that trade-off. Treasury Secretary Scott Bessent is projecting this market could grow to $2 trillion.
And if that happens, we're not just talking about a new payment rail. We are talking about a massive, permanent new buyer base for U.S. debt.
That's the strategic play.
Exactly. They are cementing a USD-centric settlement layer for the entire internet. If stablecoins scale to $2 trillion, they could absorb a huge chunk of the national debt.
Which keeps yields lower and the dollar dominant. So it all leads to this slightly unsettling realization. We are building a system where crypto stability is now intrinsically tied to the stability of the U.S. government.
And vice versa. They're linked. And here's the thought I want to leave you with. This linkage creates a feedback loop.
What do you mean?
Well, think about it. If confidence breaks in crypto and it triggers a massive run on stablecoins, what do the issuers have to do?
They have to sell their reserves to meet redemptions.
They have to mass sell their treasuries. We're creating a world where a panic in crypto doesn't just crash a token, it could force a fire sale of U.S. reserves and destabilize the bond market itself.
A digital bank run turning into a sovereign debt crisis. Something to keep an eye on. Thanks for joining us for this deep dive.
My pleasure.
We'll see you on the next one.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.